Welcome back, everyone, to Market Wrap. I'm Mo Ansari, president of Compact Asset Management, and you're tuned in as you've been doing so for nearly 2 decades now. And as always, you can call in, and I will be more than happy to share with you my 33 years of trading experience. As I had mentioned earlier, what about your 401k? Or the 201k, as a lot of people call it these days. What is going on with it now? We have somebody who can help you with some of the answers on that. On our guest line today is Mary Rowland, author of the new Common Sense Guide to Your 401k, Rebuilding Your Portfolio from the Bottom Up. Mary is a regular columnist on the Sunday New York Times and Bloomberg Wealth Manager. Her articles appear regularly in Fortune, Business Week, and USA Today. Ms. Rowland, welcome to Market Wrap.
Thank you. It's good to be here.
Thank you for being with us today. These days, many questions are coming about investing in their 401k. A lot of people are asking, is it a good idea? I put money in one end, it just goes out the other. It seems to evaporate. Despite the economic downturn and scarcity of disposable income, people are saying maybe I just shouldn't put any money in my 401k. What do you think of that? Is that a good idea?
No, I don't think it's a good idea. I can certainly understand why people would think that, particularly because a lot of us don't even have any money right now or aren't even working. Mm-hmm. So it is a tough decision. But I do think that it's still the best place that you can put money aside for retirement. It's not great. It's certainly not perfect. But right now it's the best thing we have.
Let's talk a little bit more about that. Why is it a good place? In your book, you talk about 3 options. What about the people who've been laid off, they're unemployed right now, with respect to their 401k? What should they be doing with their 401k?
Well, that's a tough question. I mean, obviously, a financial planner would say, don't spend it, roll it over into an IRA and save it for retirement. And I think that's a great answer if you can do it. But unfortunately, some of us don't have anywhere else to go for money to live on. And then I think that you've got to tap some of it. If you're laid off, you would roll it into an IRA, and then you'd have access to it from the IRA. But you would have to pay tax and a 10% penalty on whatever you took out. So you have to bear that in mind.
Doesn't the government give you some kind of a break on that look, you're unemployed, so you can take out this much and replace it later?
Unfortunately, no. They do have, as you know, I'm sure, that while you're employed, you can take a loan from the plan, right, and pay it back later. Right. However, if you take a loan from the plan and then you get laid off, you have to pay it back immediately. Okay. Or pay the taxes and the penalties. So there are some real pitfalls to watch out for if you're planning to take the money and spend it.
Let's go back to your book, Rebuilding Your Portfolio from the Bottoms Up. That's the second half of the title, the new Common Sense Guide to Your 401k, Rebuilding Your Portfolio from the Bottom Up. How do you go about doing it? Now, a lot of people have lost half of their portfolio. They put it into something. They had no idea what they were doing, and they were given 5 choices. They said, okay, you know what? Last 10 years, international stocks have done well, so they put all their portfolio in an international stock. Boom, in 2008, they lost 80% of it. It's come back a little bit in 2009. What do they do? How do they go about rebuilding that portfolio right now?
Well, if people who left their money in their 401k from, through all of this, really going back to the end of 2007 to the end of 2009, are not doing so badly. So I've seen studies that show that a portfolio over that time period might be down just a couple of percentage points. Unfortunately, a lot of people, as you say, in January, February, March of last year, the market was just so grim and it was so terrifying. I spoke to many money managers, mutual fund managers who were taking their own money out because people just thought that the sky was falling. Mm-hmm. So it's if you've taken it out, I think it's difficult, and you just have to start, inching back in and putting it in gradually.
Mm-hmm. The problem with that is probably those people had the wrong asset allocation in the first place, where they had too much risk in their portfolio probably in 2008. So when the market did go down, they lost market S&P, for example, was down 37%. They lost 40, 50, 60%. And that at that point obviously panic sets in. Oh my God, my
Yeah.
401k is gone. It wouldn't be better if people had the right mix of assets. They talk to somebody, or if they could get help on their 401k to talk to a financial advisor, and the financial advisor says, "Look, you've got a 30-year time horizon, so you can be aggressive. Don't worry about it." But somebody who's what we call in the retirement red zone within the last 10 years of retirement, they have to sort of throttle back their risk a little bit and be much more conservative, where they have much more conservative allocation. Shouldn't they have that, and somebody help them with that?
Yes, absolutely. And there is actually some good news on that front. The Pension Protection Act, which was passed in 2006,
Right.
was designed to help people make better investment choices, help them to contribute more, get more participants into the plan. And one of the provisions of that act was to provide for one-on-one advice from a financial advisor for plan participants. That would be provided by the employer, so the participant wouldn't have to pay for it. That is sort of stalled at the moment because the Department of Labor and Congress are trying to decide what type of advisor would be qualified to give that advice.
Okay, should it be a registered investment advisor, or the brokers are saying, wait a minute,
Right.
we want to be allowed to do that, but we don't want any liability on it. And the RIAs, the registered investment advisors, if a company hires an RIA, a registered investment advisor, then it becomes the liability of the RIA to give the advice. Is that correct?
That's absolutely, well, you know a lot about this, Mo, I can see. That's absolutely correct. And so in the beginning of '09, the Department of Labor came out with regulations that said both the independent RIA and the brokers and reps of large companies can give advice. And immediately Congress objected to that and came up with a bill saying that it would be only the independent RIA that would be able to do it. And that sort of went back and forth all last year, and they're expecting some kind of ruling on it any minute.
Okay, that would be great, because I think, again, if brokers give advice, they should be held liable for it, and they have to have the liability. But what the brokers want, they want to be able to give the advice, but not give the liability. But that's what large firms, that's why they have some great lobbyists to get this stuff done. And I guess that's why they were able to get the billions of dollars also from Congress. And now they're got some nice billions of dollars in bonuses also, but that's a different topic for a different day. Let's talk a little bit about the term fully vested, because a lot of times younger employees and younger people do not realize what that means, and that is a huge difference, and how that can benefit them. Could you explain that to the listeners also?
Well, yes, that's an excellent question. The vested refers to the time that the participant is entitled to the money the employer has put in the plan. Obviously, the money the employee puts in, that's his money, but the employer typically matches at least part of the money the employee puts in, and it's not until a certain time of employment, like maybe 1 year or 2 years after the participant has started working for the company, that they're vested. In other words, they own the employer contribution at that point.
So that is critical, because that's where the employee owns that money. It belongs to the employee rather than the employer, the amount that the employer has put in. So everybody should be very cognizant of that date and understand that that is money that they have gotten from the employer, and that is their money then as of that date.
Absolutely.
Mary, I want to thank you for taking the time out, because this is so important for so many people about their 401k, and so many people just don't understand how important this is, because this could be the nest egg that they're going to live on besides Social Security for 25 years in retirement. So it is very, very important that people understand this. Thank you again for being with us today on Market Wrap.
Well, thank you, and they're lucky to have you because you know all this stuff.
Well, Mary, thank you again for being with us and explaining this. Our book, The New Common Sense Guide to Your 401k, Rebuilding Your Portfolio from the Bottom Up.